Hey guys, welcome back to another video. So in today's video, I wanted to talk a little bit about how I was able to get an 83% return in 4 days in the stock market. And I did this by using an options trading strategy called call debit spread. So in this video, I'm going to talk a little bit about what a call debit spread is, as well as how you can open one in Robinhood, which this pretty much applies to any brokerage, Fidelity, Webull, or TD Ameritrade, whatever brokerage you're using. It might look a little bit different on the brokerage like interface that you're using, but fundamentally it's the exact same process. But I'm just, for this example, going to be showing you how to open it in Robinhood. So if you're new to the channel, be sure to subscribe and leave a like and comment down below what you guys thought of the video and what you guys are investing in. And yeah, let's get started. So the first step to opening a call debit spread, uh, from what I've experienced, is finding a stock that trades pretty stable generally. And one stock that I've been using to do this is Microsoft. So if you look at Microsoft's weekly trends, monthly trends, the 3 month trend, they're pretty stable compared to some of their competitors like Apple and Amazon, whose stocks like fluctuate a little bit more. And when you're opening up a call debit spread, essentially, as I'm going to get into a little bit in this video, uh, you're going to want consistency because the whole goal of a call debit spread is for your strike price to be underneath the current share price when your contract expires, because that's how you get to retain all of the appreciation on your equity. So let's scroll down here and look at the history for my action using Microsoft. So right here you can see that on August 10th, I opened up a call debit spread for $240, and then 4 days later, August 13th, I sold the same call debit spread for $440. And if you do the math, 83% return on $240 is about $200, a little less than $200, and it comes out to about $440. So I was able to get an 83% return on my purchase of this call debit spread in just a matter of 4 days. And to put that into perspective, the S&P 500, which is an index fund that follows the top 500 countries in America, it on average over the last couple decades has returned on average about 8% to 10% annually. So every 365 days, on average, the S&P 500 gives you like an 8% return. And I was able to get an 83% return in 4 days using this call debit spread. So let's open this up a little bit more and just show more of the history. You can see that on August 4th, I actually purchased a call debit spread for $160. And it doesn't actually show, it doesn't actually show like what price I closed the call debit spread at, because if you allow a call debit spread to expire, the contract closes a little differently, and I'll explain that in a little bit in this video. And when it closes in that way, it doesn't actually show you what price it closed at. It just gives you the money straight into your account without having it appear in your history the same way. But based on the fact that I bought this next call debit spread on August 10th for $240, I mean, it's a safe guess that I opened this one for $160 and then sold it for $240, and then I went over and opened another one for $240 and then sold that one for $440. And I've actually been doing this for a while, even before August 4th. You can see that I started around July 26th, and you can notice that it starts out with $200 and then drops to $160. And that's because the first time I opened this one, I actually lost money. My $200, I believe, turned into like $30. And then I used the $30. I opened another one somewhere in here in this time frame, and I turned that $30 into 160, the 160 into 240, and the 240 into 440. So I effectively basically turned like $30 into $440. So I'm going to explain right here how I was able to do that. So the first thing you want to do is go to any stock or ETF that you want to use the options for. In this case, I'm going to be using Microsoft, and you just want to go over here to trade Microsoft options and click on that. Then it's going to open up the Microsoft options calendar for you, and it's going to show you whether you're buying a call, selling a call, or buying a put. or selling a put. And then over here, it's going to show you the expiration date for the contract. So if I were to open this contract right here, I would be buying a call that expires August 20th, which today is August 19th, so this would expire tomorrow. And then you can see you can open options contracts for any dates going all the way to 2023. So the way you open a call debit spread, and I'm going to be talking about like buying and selling call options, which I've spoken about in a previous video. So if you haven't watched that video already, be sure to check it out, because if you don't understand how to buy and sell call options, then some of this stuff might be a little bit confusing to you, but I'll try to make it as simple as possible. So the way you open up a call debit spread is you want to buy a call option underneath another call option that you're selling. And the way you essentially do this, let me close out of that, is you click on the options contract that you want to buy. So I would click on this one right here, and then I would go right here and click on sell, and then I would just sell the options contract that's right above it. And you see it would open up a call debit spread. So if you're doing it correctly, it should say call debit spread right here. If you're doing something else that's weird, it'll say like custom, or if you're, let's say you accidentally like bought two of them, it would say custom again, or something else along those lines. So if you're doing it properly, it should say call debit spread when you go to open it. So you can open a call debit spread using any of the strike prices right here. For this example, I'm just going to let's use the one that's right underneath the current share price. We're going to use 292.5. So we're buying this call option for $3.55 or $3.53 per share. And since with options contracts you're dealing with 100 shares, for this options contract we would be buying it for a total of $360. And then we would sell the call option that is right above it. And so we would be buying this options contract for $345, and then we would be selling the options contract right above it for $174. And how this works is you're basically paying a debit, right? You're paying a debit. Your total cost is the difference between the two strike prices. So you're paying this premium while receiving this premium. And so the difference is this premium, which is how much you're actually paying. This is your total cost. And you can see right down here, it tells you what the max profit is and what the max loss is. So if I were to buy this call debit spread right here, I would be spending $170 just about, and my max profit would be $75. So that's almost like a 50% return. And since this options contract is expiring tomorrow, basically how call debit spreads work is as long as the share price of whatever stock or ETF that you're trading is, as long as the share price is higher than the strike price for the call option that you sold on expiration, you will receive the maximum profit. So let's say that by August 20th, after like 3 p.m. or 4 p.m., whenever it is that the market is closing for your time zone, let's say that the share price is $295.54, just like it is now. Basically, your call debit spread would expire worthless, and you would just immediately receive the max profit because the share price is higher than the strike price for the call option that you sold. Now let's say that the share price for the stock that you're trading drops below the strike price for the call option that you sold. Basically, the lower and lower that the share price gets, like underneath the call option that you sold, the more it will eat away at your profit until eventually your profit will be zero. And then as the share price drops lower and lower underneath the call option that you bought, it'll start breaking into your cost, not just your profit, but it'll start breaking into your cost. And that's your max loss right here, which is $186, which is the exact same as your total cost for buying in. So whenever you buy a call debit spread, the max that you're risking is however much you spent, and your max profit is shown right here. So the more the higher the call debit spread is on the calendar that you open up, the greater your max profit will be. So let's say, for example, instead of buying the call debit spread that's right underneath this share price, let's say we bought the one that was like above it. So let's say we bought this one for 300 strike price, and then we sold the one that was right above that over here. So our total cost for entering this call debit spread would be $22, and our max profit would be $227. So basically what this is saying is, by August 20th, which is tomorrow, if the share price of Microsoft is above $302.50, you will get the max profit of $227 for your total cost of $23. So let's say in the event of like quick like market correction, if Microsoft's share price were to drop from like 296 to like, I don't know, like 290 or something, right? That would be a good opportunity to, in my opinion, potentially open up a call debit spread right above whatever the current share price is, because that way, when the share price for Microsoft recovers and it goes back up from whatever it dropped to back to wherever it was, the share price will be higher than the strike price of the call debit spread that you opened up, and you'll be able to accumulate the max profit that way. Another strategy that you can use is just because you know, you're opening up a call debit spread, you know, right here and trying to get max profit, when you extend the deadline for your options contract, let's say we extended it to August 27th or September 3rd, right here, and we scroll down, let's say we opened up the exact same contract that we were going to open for August 20th, and we open it right here, right? So we click on the 300, and then we click on sell, and we sell the call right above it. We're basically spending $156 for this, and our max profit is $344. So that's a little over a 100% return if the share price of Microsoft, which is right now at 296, is above $305 by September 3rd. You can also do this for like August 27th, for example. So if we opened it for August 27th, and let's say we bought let's see. Oh wait, I forgot to close the contract for September 3rd. If we go to August 27th and I bought like this contract right here for 300, and then I sold the contract for 302.5, my total cost would be $73, and then my max profit would be $177. So as long as Microsoft is higher than $302.50 by August 27th, which is more than a week from now, then I would turn $70 effectively into $177. And this is basically how I was able to get the 83% return on my $240 purchase of a call debit spread for Microsoft. I basically bought in at $240 for an expiration date that was farther out, and then before the expiration date even came, Microsoft's share price had gone above my my strike price for my call debit spread, and so I just closed the call debit spread right there before the expiration date even came, which, you know, limits my risk because I'm not risking that by expiration date the share price will be lower than my strike prices and it'll eat into my profit. And I also am able to get the full return pretty much before the expiration date even shows up, which is how I was able to get the 83% return in just a matter of 4 days. So that's basically how call debit spreads work. It's pretty simple. You just open up your Robinhood calendar right here. You buy a call option right here at whatever strike price you want, and then you sell the call option right above it. And then as long as the strike price, as long as the share price for the stock that you're using is higher than the strike price for the call debit spread that you're opening, by the expiration date of whatever the expiration date was for the call debit spread that you opened, you'll be able to get your max profit, and your max loss is just limited to however much you spend on the call debit spread. So that's pretty much it. It's pretty simple. Thanks for watching. Remember to leave a like.